Hello, good morning, good afternoon, and good evening wherever you are in the world. We are so pleased to have you join us today for our webinar that we're calling Uniting Tech and Touch, Why Centaur Products Are Better for Consumers and Providers. And with a name like that, I bet you're looking forward to hearing what's behind that. Today we're going to hear from CFI fellow Alexis Olsen, who is going to share the results of the research that she's been doing under the CFI Fellows program over the last year. While we wait for a few more people to join us, let's go ahead and put a poll up on the screen to better understand who we're talking with today. So on your screen, whether on your mobile device or on your computer, you should see a poll that pops up, and it asks which of these categories best describes you. You can select one of the following options. The first is government or public sector. The second is private sector. The third is development organization. The fourth is academia or a think tank. And the fifth is other. Please do your best to pick one of those categories. It looks like about 60% of you have had the opportunity to vote, so we're going to leave it open for just a few more seconds while you make that decision. All right, let's go ahead and close the poll. It looks like we have a lot of people from the private sector, about 60%, followed by development organizations and academia, and a few who self-identify as other. So in the Q&A section, we're going to have to hear where you're coming from, and would love to make our conversation responsive to who's joined us today. Let's put up one more poll so that we can understand where the focus of everybody's work is who's joining us today. So what's the primary focus of your work? You should see a poll that comes up on the screen for you here. You'll be able to choose from one of 5 options: Asia and the Pacific, Europe and Central Asia, Latin America and the Caribbean, Middle East and North Africa, and Sub-Saharan Africa. It looks like we may have had a technical glitch here where the poll was closed too early. So I don't know, Neil's our technical expert here. Can we go back and relaunch that poll? Looks like we can't relaunch the poll. So, but wherever you are in the world, we're so glad that you've joined us. The focus of this conversation, obviously, as you know from the title, is on Kenya, but I think there are some lessons that can be learned for other parts of the world here, and so we'll be sure to talk about some of these questions of applicability beyond Kenya in Sub-Saharan Africa and in other regions of the world. Let me just go over a few housekeeping items. First, I want to note that we've muted all of the participants for the presentation. That's all of you, but we certainly want this to be an interactive session following the presentation of the research. So I would love to call on people individually. The way that you do this is that you would raise your hand, which you can see the control panel there on the right side of your screen. I've just put up a screenshot. And then if we move forward one more slide, we've zoomed in on the control panel here. So in the left screenshot, you can see the hand button. And so if you want to raise your hand to be unmuted and ask a question, please feel free to press that button, and one of our staff will be in touch with you and ask you about what exactly you're hoping to get out of the conversation, whether you want to be unmuted, and then we'll be sure to find a place to in the conversation to call on you. And then finally, on the right side of the screen, you can see the screenshot. There's a question box in the drop-down menu that says questions, and that's a place where you can type in your question. So I look forward to hearing from you. I also want to note that we're recording this session, and we will be sharing it on our website afterwards for those who wanted to participate in this webinar but were unable to do so. So let's get into a few introductions. I'm Sonja Kelly. I'm the Director of Research at the Center for Financial Inclusion at Acción, and I have the great privilege of directing the CFI Fellows Program. The CFI Fellows Program was established more than 2 years ago, and we established it because we had this goal of wanting to give independent researchers the space to be able to study things that they thought were important to moving financial inclusion forward. We established a set of questions that first year that were topics that we thought were frontier topics in financial inclusion, things that were truly unanswered, but whose answers would really catalyze the financial inclusion space and answer some of the most important challenges in financial inclusion. So our first cohort was located in 3 different countries, conducting research on about 20 different markets. Our second cohort, of which Alexis is a part, is based in 4 different countries, or was doing research in 4 different countries, and focusing on questions ranging from data security to this question on tech and touch and what is the interplay between them, to questions on the business case for financial capability. So really broad-ranging questions. And as we disseminate these results over the coming few months, we really look forward to having robust discussions that move forward financial inclusion. I'd like to introduce Alexis now. Alexis Beggs-Olsen was a CFI fellow for this past year. She's also an independent consultant and works with a number of different organizations in the financial inclusion space. Prior to consulting independently, Alexis was a technical advisor with Opportunity International, and I actually, in full disclosure, first knew her from my days at Opportunity International. Alexis has been such a pleasure to work with. She is the only fellow that we had that was willing to uproot her whole family and move across the world to conduct research on a topic that she cared deeply about in a country that she was really excited about learning more about and engaging in. What I really liked about her research, and you'll see this come across, was her willingness to engage both with financial institutions and also in direct conversation with consumers who were not affiliated with financial institutions. I think from my experience, it's really easy in the development community to go through financial institutions in order to talk to customers. And of course, if the financial institution is the one brokering the conversation, the customer might be a little bit more biased to say favorable things about the institution and their existing services. But the fact that Alexis was willing to literally just walk into the slums and ask people about their use of financial services shows a lot of research integrity in the international development space. So Alexis, I'll turn it over to you to share with us the research question, the results, and to tell us what Centaur Products really means.
Absolutely. Thanks, Sonja. And I want to thank everyone who has joined the webinar today for taking this time out of your busy schedules. I know each of you has a lot going on as you are working in this sector, and so I appreciate you taking the time to learn about this research. I want to thank CFI for their support of this research project, and for those of you who are action-oriented researchers, whether you're from the academic space or the practitioner space, which is where I'm from, I highly recommend that you keep an eye out for future RFPs, because this is just a really great group to work with. They invest a lot of their time and knowledge and experience, and I feel like my project was a lot stronger because of their guidance and the insights that they invested. So I also want to give a brief shout out to my Kenyan research associate, Veronica Viata Zakayo. She provided deep expertise, especially in qualitative research in very rural areas. And so I'm really glad that I was able to connect with her, and she really helped strengthen this project. So let's just talk through the presentation roadmap. We'll start with an overview of the research questions, the methodology that we used. Then we'll dive into the results and talk through the key findings and recommendations. And then the part that I'm looking forward to most, the discussion, hearing from respondents as well as those of you who are in the field, and look forward to learning from your insights. So this project really focused on the question of how and when does human interface need to be integrated into digital products to effectively serve customers. Of course, we hear a lot about digital, our whole sector's move towards digital services, and it's very exciting. It's raised a number of questions, and as Sonja mentioned, CFI has researchers out there doing, research on a number of these questions. This question of human touch is really important, particularly since we are serving the base of the pyramid. Many people in our target population are new to the formal financial sector, have lower levels of education. So to really answer this question of how and when we need to integrate human interface, we had to answer two other questions, and that is who within the target population will want and need human touch more than others. And then secondly, what specifically are these customers trying to accomplish at moments when they desire human contact? Our focus was in Kenya, and so I need to just apologize because I know there are some people on this call that probably have heard enough out of Kenya, but there was a good reason that we picked Kenya for this research project. I know a lot of research has been done there, but we really wanted to study value-added services beyond payments, so digital savings, digital credit, digital insurance, and Kenya was a good place to do that just because of its market maturity and the deep penetration. Mshwari alone, a leading digital loan and savings product, serves 17 million people out of a total population of 49. So as Sonja was saying, if you're just walking into a community, Kenya is a place where you can find people using these services in urban areas. Rural areas, at least they've heard of them, and some people in rural areas are using them as well. So it was a great place to look at a market where people have become accustomed to these over a few years, and to look at a market at that point in its development. How do people feel about digital interface versus human interface? So I'm going to give you a very quick overview of the market in Kenya. We could actually spend our entire time on this slide just because it's so interesting what's going on there. But if you look at the top part of the slide, this provides an overview of 5 types of financial service providers along a spectrum from low touch at the left side of the slide. So low touch with a picture of the phone there, indicating that interface between the customer and the financial service provider is primarily through the phone, all the way over to high touch on the right-hand side of the screen with a picture of the person, indicating more of the traditional approach where human interface drives the financial relationship through branch staff, through loan officers. So looking at these service provider types one by one, the first group on the low touch end of the spectrum are app-based providers like Tala, Branch, Saida. These providers interact digitally, so credit decisions are automated. If a customer has a question, they can reach out through Facebook or the Play Store, the Google Play Store, where they downloaded the app. Most phones in Kenya are Androids, so that's where they would have sourced it, or through in-app chat. And then moving to the right, telco-led products like Safaricom's Mshwari, Airtel's Copacash in partnership with Jumo. Again, credit decisions are automated. Most of the customer care happens through a voice-based call center. Bank-led products are kind of in the middle. Credit decisions. So of course at banks, there are sort of 2 streams of products. The traditional products, the larger products where you can walk into a branch, and if you qualify, get a loan, after providing the paperwork and meeting with a loan officer. Banks are offering digital products as well that are automated in terms of the credit scoring. They are serviced primarily through call centers as well. Some banks do provide customer care for digital products from their branches. Equity is an example of a bank that does that. Many banks don't. So if a customer has a challenge or a question, they'll be directed to call customer care. The fourth category are hybrid MFIs like Musoni, 4G Capital. So this is a group of institutions that are trying to really incorporate both tech and human touch. Their methodology is very much field staff driven. However, they equip their field staff with digital field applications, provide digital workflows. The credit assessment for the first loan does need to be verified by a human being. Reloans are often automatic. So first loans happen in 24 hours, in some cases up to 48 hours, and then reloans happen in minutes. The third the fifth final group of institutions are the traditional MFIs and SACCOs. Now in Kenya, all financial institutions, payments happen primarily digitally. So they are digital, but in terms of value-added products, they're providing those products traditionally. And loan turnarounds are often 1 to 3 weeks, which is a significant competitive disadvantage in that market. So many of these institutions are moving more towards the hybrid side of the spectrum, but at different rates of speed. So our methodology, we took a two-pronged qualitative approach. We wanted to really learn from the frontline thinkers who are living and breathing these questions every day. So you see the names of the institutions that participated there. We're very grateful for their sharing their insights and experience with us. They did provide part of our sample group. We asked each provider to give us both active and inactive clients. And then we also sourced our respondents independently. So we ended up with 104 independent respondents. And the process that we did with each of those was a 90-minute qualitative interview. We started by doing a scan of their current and past use of financial services. And then based on what they shared in the scan, we chose one experience, one product to do a customer journey mapping exercise. So we asked open-ended questions about each stage of their customer journey using the framework developed by GMSA. And so then as they were sharing their story, we drew it basically using, we're not artists, but we did stick figure drawings, and that provided a really nice storyboard for us to look at together with the respondent to pinpoint their wow factors, their pain points, and then to delve more deeply into questions around human touch. And then we finished the interview with a series of questions on looking at each stage of the journey in general, their journeys with financial services. Do they prefer to interact with a person or with their phone? And we showed them the two images that were on the picture of the phone and the icon of the person, and asked them to pick one. So for example, when you are signing up for an account or service, including accounts or services on your phone, would you rather do that on your phone, or would you rather talk to a person? So let's dive into the findings. We found that in general, people who use digital financial services are happy about them. They provide fast money when there's an urgent need, and they also provide additional funding for larger expenses. We found that digital outperforms human interaction in a number of ways. It's more convenient once you learn how to use it, more predictable, with the one significant exception of loan approvals or rejections, which are often, people are often a little mystified in terms of why a loan, in particular when it isn't approved. And then with digital products, collections are much less stressful. But while Kenyans' comfort levels for conducting transactions digitally is high, we found that other key aspects of the journey are not adequately handled by digital means alone. So let's dig into this. So this graph looks just at one segment of our sample, and this segment were those actively using low-touch digital products. So these are people that we already know have some comfort and familiarity with these products. And when we asked them, looking at if you look at the bottom of each bar, it kind of goes through the stages of their customer journey. So looking at the first bar on the left, when you're getting information about loans or savings options, the orange section of that bar are those who would prefer to interact on a mobile phone. And then the blue section, the dark blue section, is those who'd prefer to interact with a human. And then the very light blue section at the top were those with no preference. And we didn't actually offer that third one as an option, but if they said, I don't have a preference, then we obviously marked that down. So as you look, as people move through their financial journey, when they move from getting information to signing up for an account or service, their comfort with the digital increases. Conducting regular transactions, depositing or withdrawing savings, getting or repaying a loan, Most people are very comfortable with that. But then when it comes to asking a question, people start moving back into, greater interest in talking with a person. When it comes to resolving a problem or complaint, then a dramatic majority, more than 3/4, prefer, and in many cases strongly prefer, to interact with a person. Looking at the segment of our sample where people were using financial services but not low-touch services, this same pattern was visible as you went through the financial journey, although with a much higher level of preference for interacting with a person. So let's look at why respondents want human touch, and then we'll take a detailed look at some of the segments of our sample. First of all, people want touch to interact with a human to verify legitimacy. Fear of fraud was a very significant theme in many of the interviews. So let's look at this journey map from Edith. Edith received a text advertising Mshwari. She's skeptical at first, wondering if these people were like agents who wanted to misuse her money. What do these people want from me, she wondered. Her brother, who'd already tried Mshwari, told her, no, these are not agents, these are good people. So she tests it out and she sees that her money is safe. So we were really surprised to find that 80 out of 93 of our customer journey maps their stories started this way, with people hearing about a product or service, having questions or concerns, and then going to a trusted person, a friend, a family member, a neighbor, a coworker, and asking for verification. In one customer journey map, a respondent went to a friend to ask to borrow money, and the friend said, have you tried Tala? And the respondent said that when his friend asked him that, he laughed because he had been ignoring a Facebook ad that he had seen repeatedly that said, have you tried Tala? Because he was waiting for that testimony of someone he knew who had tried the product. So out of our 93 customer journey maps, 13 of them did begin their use of the product without the testimony of a trusted person. A number of those people had seen mass media advertising with a trusted brand and were instructed on how to initiate contact. Although interestingly, some of our respondents said that they expressed a concern that they would not be able to discern the difference between a real text from Safaricom versus a fraudulent text, phishing. And so people's sense of their confidence in their ability to spot a scam face-to-face was much, much higher. But of the group of just our most active users, we had 5 folks that did feel comfortable enough with their products to just reach out, to Google, go to the Play Store, and these were people who had already used between 2 and 6 digital products. So gaining confidence, beginning to go out onto the internet looking for these kinds of products. So reason number 2 that people want to interact with a person, to really understand the product. We heard that in-person communication offers thinner margin of error, it's easier to understand. A lot of people talked about leaving satisfied. That phrase was one that emerged in a number of interviews, just feeling that everything will be explained properly. In-person conversation allows for pacing that, that for questions, nonverbals, back and forth. And then also it provides staff with boots on the ground who understand the context, that speak the local language. And so a lot of people really kind of indicated that they felt like they would understand better if they were talking about a product in person. And the third reason, and the very strong reason as indicated here, is to resolve problems. There was a very strong sense of skepticism that disembodied forms of communication, whether it's text or in-app chat or even call center phone calls, would get the job done in terms of solving their problems. So you do see that there is a segment, there's 12 people there, that would prefer to interact digitally to resolve complaints. If you were to go to any product's Facebook page, you will see there are people, registering concerns, but we found that that's a very small minority of the respondents. And so just a few stories to dig into why that might be. So Edwin was a security guard, a private security guard. He lives in Mathare, a slum in Nairobi, and he had a payroll account at one of the major banks. And he had availed a number of times of a payroll advance loan. So last December of 2016, he got a loan and that he had neither asked for. He was actually instructed to repay a loan that he neither asked for nor received. So went to the bank manager and spoke to the branch, the staff there, and was able to resolve the problem. Satisfied with that customer experience, he did take a loan out for the holiday season of $120. So Edwin earns he earns $150 a month. He's got 3 kids, a 4th on the way. His wife is currently expecting, or at least was when I talked to him in April. And so he took out this holiday loan for Christmas, and then it began to be automatically deducted from his payroll account in January. Somewhere in February, the bank switched from a system of automatic deductions to the customer having to initiate a digital repayment through an app. Edwin said that the change wasn't communicated very clearly, and he didn't really understand what was happening. He did notice that his account was not being deducted, and he did not take action. But when I spoke to him in April, it was just a week after the bank had deducted his entire paycheck for the previous month, and he was left with no resources. He was expecting those funds to repay a loan, as well as to care for his family. He had called customer care 5 times the previous week. Each time he spoke with a different person and was unable to resolve his problem. And then he went to a branch and asked for help. So the picture that you can see there is a branch staff member pointing him to a phone. He was actually directed to a phone in the lobby of the bank that was directed to customer care. So kind of cycled back to the same system that had not been able to help him previously. Lewis is actually a small enterprise owner. He owns a CCTV installation company, which has 2 employees. It netted a little over $20,000 last year. Lewis, a few years ago, a friend of his told him about a digital loan with one of the major banks. And so he tried it out. He borrowed $10. And then he kind of forgot about it. It was a busy season at work. He forgot his PIN. He got reminders, but he didn't know his PIN, so he couldn't get into repay. And then he just kind of moved on. So a couple years later, shortly before I talked to him, he had been rejected from another digital loan from his primary bank, so the bank that he saves with, a bank where he's gotten a $500 in-person branch loan. So when he was rejected for a digital loan from this bank, he was understandably upset, and so he looked and saw that he had been listed at the CRB. And so then he went back to the first bank where he had the $10 loan to try to repay it, but he was told that the loan had been written off and that he could not repay it and that he could not remove his listing at the CRB, and that there was nothing he could do. So there again, I know small and medium enterprises are a big focus of development in sub-Saharan Africa, and seen as a way to create jobs for this kind of generation of youth that's coming through. And so here we're seeing, one SME owner kind of caught and wanting to extend his businesses and wanting to launch a new line of business actually, but unable to because of his CRB listing. So finally, my third example is Christine. She's a greengrocer in Machacos County, and she used a product multiple times successfully, and then her business went down and she wasn't able to repay her loan. So Christine is in her 50s. She did not complete primary school. Her business went down and she began to receive texts asking her to pay the loan, advising her of the possibility of CRB listing. And she began, the texts came so frequently that she began to become quite stressed about them, to the point where she actually hid her phone away where she couldn't hear it. She had an interesting perception, a misconception actually, that the provider would limit her phone's ability to communicate with anybody. She would be able to identify 2 phone numbers she could call, but anybody more than that, that she would not be able to use her phone for making phone calls, which was very stressful for her because she has 5 kids, adult children, and use the phone for the business. So it was a significant source of stress. I asked her, during this time when you were concerned about your phone being restricted, did you ever call the customer care line, to find out what would happen if you didn't repay? And Christine, kind of laughed at the question, and she said, not only did it not occur to me to try, it wouldn't have helped me if I had tried. So there's definitely part of the population that won't initiate contact during challenges. So let's quickly look over some segment observations, and I'm going to breeze through these pretty fast so that we can also talk about some recommendations. This one looks at, so in general, men were more comfortable with digital interface than women for every stage of the journey. The biggest difference was when it comes to asking questions. You can see in orange, more men prefer to interact on a mobile phone than with a human. When it comes to asking questions, many more women prefer to interact with a person than on their phone. With rural and urban segments, again, urban is more comfortable with digital interaction at every stage of the journey. But the biggest difference was actually when it came to signing up for a product or service. And that's just kind of interesting. You can see how the population density in the urban areas, the know-how of how to do this spreads more quickly, whereas in rural areas, people really do need to travel to a bank branch. One respondent said, once I got to Equitel, or once I got to the equity branch and they explained how to do this, step by step, it was easy, but they need someone to walk them through that process. And then two different interesting observations on the type of phone. I found it really interesting to interact with people who are using smartphones and to see that a majority of them still preferred to get product information from a person. And so a lot of the people I talked to were new to smartphones, and in some cases, didn't have the resources to, consistently have data. So it was more of a sort of a tentative, occasional resource that they could have access to. But when they did have access, they were getting so many different offers of, fraudulent offers from financial companies for visas to move to Canada. I mean, there's just a lot of phishing happening in the environment. So as people adjust to using this, having access to the internet for the very first time, there's a learning curve. And so for some people, it actually heightens the need to interact with a person because they need to sort through all of this information that's coming at them for the first time. Another interesting finding based on the type of phone was just how universally feature phone users rely on human interaction for solving problems. So just a very small part of the segment, I think it was 2 people, said they preferred to interact with a mobile phone to solve problems. So with that piece of hardware, really human interaction continues to be important. So the recommendations. So Sonja mentioned at the beginning, we've included this concept of centaur products. Centaurs are, of course, a mythical creature with the upper body of a human and the lower body of a horse. We borrowed the concept of a centaur product from Centaur Chess. So in 1997, the world's chess grandmaster, Garry Kasparov, was defeated by IBM's Deep blue computer program for the first time, which was the first sort of moment of like, wait, can computers outsmart people? And Gary went on to found a kind of chess that integrates both human and computer team members. So the computers provide the brute calculation force. They run scenarios based on historical games. The human then uses their wisdom and experience to make a decision on what's the move. Do I trust this particular system? Do I use my own skill? And interestingly, those teams have performed better than computer-only teams or human-only teams. So we want to really encourage, coming out of this research, people in the financial services provider to think that way. Think about, technology and human interaction each has their own strengths. And what does tech do best and what do people do best? So coming out of the research, there are some clear ways where we can improve services by improving technology. Technology provides safeguards against flawed or inconsistent human behavior. We found a real issue. 6 of our respondents in such a small sample had lost some savings due to human fraud. And so automated digital messages that inform customers of cash movements into or out of their accounts is important. Communicating rights and redressal mechanisms, including how to contact a centralized phone number to talk through challenges, casting a wide net for feedback, including free-form text responses. And then for institutions that have human interaction, technology provides an opportunity to capture very context-rich client data. This will give financial service providers better control of the business, and really understanding their customer segments can provide some opportunities for tremendous competitive advantage. We also want to advise improving human touch, and we'll kind of chat about each of these: boosting agent support capacity, improving the quality of call centers, using branches strategically, and partnerships. So agents need to be well selected and well trained. In Kenya, most agent transactions are purely that. They're, even with banking agents, there have been attempts that have been made to roll out sort of account opening processes, but then they've been withdrawn again due to fraud. So it's not easy, and I think there are probably other markets outside of Kenya that are further along. So I'd be really interested to hear those of you on the call who have had successes with this. Improving the quality of call centers, so really ensuring that your call center staff are customer advocates, that they are effective and empathetic communicators, that they're equipped with what they need to really solve problems, that there are fast means to escalate if a problem is not solved right away. And Jumo is a great example of that. They run an escalations hub that if a problem's not solved in 48 hours, it becomes centrally controlled, and they network with engineering or treasury or fraud to solve it quickly. And just the investment in systems, training, and supervision that this requires is an important investment. Using branches strategically, while it makes sense for some FSPs to specialize at the low-touch end of the spectrum, I think most FSPs will not need to offer a lean but strategic physical footprint to service the more advanced aspects of value-added products. But there's a lot of room for creativity here. If a branch doesn't have to handle cash, it can be as simple as a kiosk in a market. And the physical space really does not determine the quality of the human interaction that's happening. Branches also provide an important advantage to financial service providers in terms of contextual verification of mobile data on customers, and as loans get larger, that significantly reduces risk. And then partnerships will drive the next generation of financial services. 2 examples we saw in Kenya were Acre Africa, an index-based crop insurance product. They partner with Safaricom, Seed Company, UAP Insurance, Mobigro, which targets smallholder farmers with loans and savings insurance. They partner with farmers associations, both to get really good financial information on the farmers, as well as to provide human education. So I think the partnerships are really going to be an important piece moving forward. So just leaving you with a provocative, hopefully, question. Can centaurs outperform unicorns? Of course, technology comes with this sort of glamorous sheen, but I think from what I've seen in Kenya and what's developing elsewhere, I think there's some really exciting opportunities in the future for providers that really think carefully through, what does technology do best? What do people do best? And to build products and services around their answers to those questions specific to their own target market.
Thanks so much, Alexis. And that's a very provocative question. Can centaurs outperform unicorns? But what it represents is a really important question in our industry. And I'm so grateful for your research speaking to that. You may have noticed that we put the report in the handout section of your webinar. So in the control panel, there's a drop-down menu called handouts, and the report's right there. So feel free to peruse it over the rest of this webinar if you want to dig a little bit deeper into some of those stories that Alexis shared with us. I just want to note that I have my eye on the attendee list and on my control panel here, and there are so many of you on the line that I would love to hear from in this discussion. So please feel free to raise your hand. You do that by pressing the hand icon on your control panel, and then we'll be sure to unmute you for the discussion. So to kick off our discussion, I'd like to turn to John Lwande. John is the Program Director of the Africa Board Fellowship, which is dedicated to strengthening governance, risk management, and strategic leadership for executives and board members of African financial institutions serving low-income clients. We asked John to comment on this research, both because he helps financial institutions through questions like this, but also because of his experience at Akiba Commercial Bank as Managing Director from 2008 to 2015. So John, would love to hear your reflections on this research and this topic.
Well, thanks, Sonja, and welcome everybody. I actually just wanted first to go back again, of course, thanking Alexis for a great job, well done, and having spent her couple of months in Kenya with her family and enjoyed, Kenya very much. Hope you'll come back again. The part that I wanted to talk about is when we talk about digitalization, I think there is sometimes a myth that we are abandoning the interaction with the client, but the interaction with the client will always remain key, and interaction not virtually, not remotely, but physically, especially in the lower market segment that we are working. We agree that digitalization will help in terms of creating economies of scale, efficiencies, and actually more recently, some people have criticized this as not really targeted to benefit the client, but more targeted to benefit the institution by cutting costs, reducing the lines or the queues in the banking halls and so on and so forth. But really, going back to my point is that the missing link that we normally see with this, the Lord Hatch environment is where there is no special attention given to customer education. And customer education is critical in ensuring that people do understand your product, because in the lower market segment, if people really do not, understand your product, and especially that people's needs, people's tastes do evolve over time, then it may be very artificial for you to imagine that people will consume your product without having a close, contact with them. And Alexis did mention that when it comes to customer service, of course, the app cannot really take over the customer service role, and it will dilute that customer service in terms of explaining where there has been failures or there has been these queries that people do not understand. And that takes me to my own experience using peer-to-peer, education, that a lot of times at the very base of the pyramid, the best people to extend the customer education is actually not even your staff. Of course, your staff can do it, but the opinion leaders amongst the clients are very good people that can offer, great resources in terms of showing others how to use this product. It is as simple as one customer demonstrating to the other that I can use this, and the other person saying, sure, if you can use that and you can show me how to, then I'm sure I can use that as well. So I think the client education part will remain key. And again, to realize that in terms of remaining current, remaining up to date, you will always have the development cost of ensuring that your products remain up to date with your clients. And that is an issue that involves investment. So it's not that you put money into computers and therefore you have gotten rid of certain costs that will go, just go away. They'll not go away because the client base also evolves. There's another part to this that will really be beneficial if one, plans to go high touch. You realize that from the graphs that Alexis was showing us, a very small number of people will comfortably make a call and find out the problem and resolve an issue over the phone. But again, that's the very smaller number of the people who are very, fintech savvy. Again, who have got a confidence in using, these digital products. So I think it's important for us to realize that as much as it's a great story, we need to invest into data analytics, but the starting point is to collect as much data as we can and profile the customers as much as we can, so that when we come out with the products, we're able to address the consumption of the customer, other than us imagining that this product we've come out is the best for everybody. I should refer to Juma, and I like Juma's story of balancing empowerment with protection. And that is the way that while you empower the people on one hand, you also need to ensure that their very basics are protected. Somebody should not feel like they cannot even dare, make a phone call and ask and question certain entries or certain transactions they do not understand. We've had stories in the market in Safaricom where there are certain apps that, for some reason, if you just click on without knowing, it's already on your phone, and there is a constant charge ongoing in the background, in the back office, without your knowledge, and over time, there's just a little money that's being deducted. Of course, some of these issues are being investigated. And actually, some of the regulators in the region have urged institutions that go digital, but be very cautious as you go digital. Involve the stakeholders, involve the regulators, involve the customers, and really, have a best meet of the mind on the product for the customers. And again, some people have even attacked digitalization as a flawed intervention. Of course, some have been very cynical, comparing, some of this intervention with subprime loans on the Wall Street. But the reality is that I think digital does indeed, you can think about it in terms of opportunity costs, whereby instead of a customer having to shut down the business or having to travel, for long hours, or having to leave, certain family things, unattended to, if they can run that off the phone, where they are, at their convenience, at their own time, then it really saves time and creates efficiencies on both sides, for the client as well as for the institution. So I think with that, I'd just like to say that, we're living in a digital world, and we're not going to run away from it. And it is also not going to go away from us. I think it's better how we can, have some good customer education programs to engage the customers and to try to bring them on board, because these are things that are there, and these are things that everybody is striving for. So that's what I would like to share. And again, thank Alexis for this great story that she has come out with from Kenya. Thanks, everyone.
Great. Thank you so much, John. Let's turn now to Lauren Hendricks. Lauren is the Executive Vice President of Strategy and Institutional Relations at Grameen Foundation. We asked Lauren to comment on this work because of her rich knowledge of the financial inclusion space, coupled with her focus on customers. And so, Lauren, I think that you might have some insight into this topic and would love to hear your response.
Great, thank you so much. And I wanted to start by talking, and I wonder if Sonja, if you could go back to the slide, partially just so I don't have to look at myself while I talk. But you had a slide that kind of laid out the spectrum of the different types of products, everything from Tala to SACOs and MFIs. I know it was like your first slide. There you go. Thanks so much. But you know, I wanted to, because we've been talking about kind of the digital interface and digital, you know, kind of high touch versus high tech. But there's another part of this, which is the product piece. And you know, I think it's quite interesting that a lot of the recommendation that you're making around these kind of Centaur products, which come a bit in the middle of this, some of the hybrid MFIs and bank-led solutions, are also the ones that have the best product flexibility for the end client. So when you look at the more app-based and telco-led solutions, because they are limited to, in most cases, to data that is kind of readily available and it is very kind of phone-based data, they have a very limited view into the client. And so they're only able to offer very surface products. And when you get to the other end of the spectrum, the traditional MFIs and SACOs, because they don't use any kind of digital solutions to enable their operations, they are forced to be quite rigid about products and services in order to make operations as efficient as possible. So they don't gain any operational efficiency from digital. But if you look kind of in that middle at the Musoni and the Equity and Equitel, they have the nice balance of they're able to digitize the central processes around cash handling, but still maintain that client interface that lets them offer a broader range. So through Equitel, Equity is able to offer their kind of full range of products and services to clients. So loans everywhere from agricultural loans to health loans to school loans can all be accessed off the Equitel platform. Similarly, Musoni, because they have a field staff that interacts with their end clients and collects data on their end clients around agricultural practices or around their small business, they're able to make loan decisions based on the actual business of the client. So Musoni is able to tailor their agricultural credit to the actual size of the client's farm and to the actual crop that's grown. So a maize loan has a different grace period from a loan for soybean or from a loan for tomatoes. So they're able to customize it because they have the frontline staff that are able to collect information on clients. And so I think that this focus on how do we use digital both to make the cash flow more efficient, but also to make data more efficient. And you know, sometimes there's this assumption, well, data can all be collected digitally, but I don't think that that is correct. When we're trying to dig down on the information around a client's business or a client's farming activity, having a field staff that can verify that information provides greater kind of trust in that data that's coming in. Digital can also be used to make sure that inline field staff are giving consistent information to clients. So whether that's information about product, whether that's information about if they're supporting them in agricultural processes, there's a quality control then around the information that's going to the end client because the field staff is able to have that digital support. You know, in places like Tanzania, where you have you know, where the mobile money agents are interoperable and therefore they represent all the different telcos, they really are unable to articulate the differences between the telcos. They're unable to articulate the different products that each of the telcos offer. And in these methods, so having a digital product that allows the field agent to refer and get accurate information on products leads to a better client experience. So the client isn't taking up a product and then finding out the features, the costs, etc. I will say one of the things I wanted to talk about as well is the gender differential, and particularly when outsourcing to agents. And Sonja, I thought you really well reflected the difference in the genders in kind of ease and comfortableness with digital platforms. And I think a lot of that comes in the fact that there is a gender divide in digital access and use. And so women tend to be less comfortable with digital platforms to begin with. But I think there's also a reinforcing factor that the vast majority of agents tend to be men. And so women are intimidated, or for cultural reasons have different difficulty interacting with male agents. There's a lot of research out there that says, male agents are less patient with women. They don't take the time to teach them how to use the system. They'll often just take the phone from them, ask them for their PIN, and do the transaction for them. So we need to think about ways, and a lot of these companies think, well, we're not making preferences about the gender of our agents, but we are requiring that they have X amount of cash for the float. We are requiring that they have an existing business that's been in a physical location for over a year. And all of those things then skew it towards having more male agents. And so thinking about what are the approaches and tactics we need to use to make sure that when part of the relationship with the financial institution is outsourced to an agent, making sure that we are bringing in female agents to make sure that women are comfortable and able to use products. And I think the last point I'll make, because I know I'm getting to the end of my time, is, I think we are putting a lot of pressure on financial institutions around costs. So we're asking them to go both high tech and high touch. And a lot of them thought, have made a strategic decision. Okay, well, I'll go high tech and then I'll save the costs on the high touch, or I'll go high touch, but I won't invest in the high tech. And so there is a cost to financial institutions in going both high tech and high touch. And I thought one of your points at the end, Sonja, was excellent. And I want to suggest that when we talk about centaurs, we're not necessarily just talking about bringing together kind of high tech and high touch, but we could also be thinking about bringing together these partnerships of very different types of institutions and organizations. So as an example, we work in Achilla, which is a grain off-taker, and Opportunity International. So Achilla is able to use their field force to collect information on the farmers. They're able to use their field force to provide extension services to farmers, but they digitize all of that information. And so Opportunity Bank in Uganda is able to access the information that Achilla has collected on their farmers and make credit decisions based on that. So it's the blend of using a data-based financial or loan decision making, but having that field force, even though it's not your own, having a field force out in the field that's able to verify that data, but also to provide the technical support to the end client. So I think centaurs don't necessarily have to be all inside one organization. They can be partnerships between organizations where one brings high touch and the other brings the high tech. So with that, I'm going to leave it and say thanks so much, Sonja. I thought it was an excellent report.
Thanks so much. That was really insightful, Lauren. I especially appreciated the gender lens and your comment on how realistic centaurs are. We had a fun comment from Wayne Hennessy. He wrote into the question section to us, "What about Minotaurs?" And I think that's a very good question. So with that, let's go ahead and open it up to the line to make sure we hear from all of you. I'd love to turn first to Susan Johnson at the University of Bath. Susan has a lot of experience researching in Kenya, and so Susan, would love to hear both your question and also any reflections you have on this research from Alexis Beggs-Olsen. Susan? We're having trouble. We haven't heard you yet, so if you can keep testing your sound, we'll keep trying to unmute you from our side. Looks like you're unmuted from our side. So Susan, could you test your sound on your end? Looks like it should work based on what the tech is telling us. All right, well, we're having trouble with that, but fortunately Susan did type out her question, so I'm going to go ahead and read it, and if we're able to get Susan on the line while we're addressing her question, we can still hear from her. But Susan says, to what extent did respondents want to be able to discuss the loan scheduling? Her research in Kenya shows how people see finance as part of a social relationship, and therefore they want to be able to understand the nature of that relationship. So the finding that they want to speak to a provider might not just be about the understanding, but also about being understood. This particularly comes into play when the client has repayment problems. And they want to be able to negotiate an adjustment. So this is the point she would particularly expect clients to want to be able to speak to someone who might be part of the institution. And did you find that out of your research, Alexis?
Absolutely. I think that's a great insight, and that's a great way to say it. And I came across that very frequently. It was interesting talking. So for some of the digital providers, when I asked them for active and inactive clients, the inactive clients that they gave me were often clients that had been in arrears or were currently in arrears. And when people get to that point where they can't repay, they do want to have a conversation. And there are very different perceptions on what kind of flexibility should there be. Some of the providers do offer like a 7-day grace period without penalty. So it's interesting. I think there's also a difference in perception when a customer is struggling to make a payment, and then they kind of work out their situation to be able to make that payment. But let's say, for example, it was a few days too late. I think in the mind of the customer, and as they expressed, from their perspective, they've righted that relationship. But from the digital service provider's perspective, that loan was late, and so in some cases there's a sort of a penalty. If they apply for another loan right away, they'll have to wait. And I think in those moments people become very confused and say, wait, I actually struggled to repay that loan. Yes, it was a few days late. If you and I were friends lending each other money, we would understand. But because there aren't those kinds of connections and there isn't that kind of relationship, there is misunderstanding around that. I do. So I think that's an excellent point, and I would agree with you that is one time when people want to reach out. And in talking with Jumo, they said that a significant number of their customer service calls are people wanting to just say like, hey, I just wanted to be able to explain why I'm going to be late. And they train their customer service agents to just have a very, an empathetic, sort of compassionate response. The policies are still the policies and need to be followed, but just giving the person the experience of having a conversation with somebody who can provide some empathy to their situation. Jumo feels like the customers who reach out to do that are a segment of their total customer base that they want to protect, because these are people with a sense of internal responsibility, and they're people that they want to continue to have a good relationship with. It is interesting though, because there isn't that face-to-face relationship, there is that segment of the population that when they get into trouble won't reach out. So that was another interesting finding too, that just the physical distance and the idea of calling customer care, as in the case of the one story I shared, prevents that relationship development. So I think the insight that people want to have communication to be understood and to sort of negotiate flexibility is absolutely true.
Great. And if we haven't heard Susan yet, I don't think we have a good connection or there's something going on. But Susan, we'd love for you to jump back in if we can figure this out. I'd love to turn now to Abdel Lawani. Abdel, you had a good question about local language and how that makes a difference in terms of quality of interaction. Abdel, we're going to try to unmute you here. Abdel, are you with us? Abdel, we can't hear you quite yet. Abdel, are you with us? It looks like you're unmuted from our side and from your side, from what I can see in the technology here. Let's try one more time, but otherwise I can read your question. Okay, well, oh, great. Abdel, go ahead and ask your question.
Yes, thank you. My question was about how, if the research explore how the way the tech work was able to increase how comfortable customers were with the service, like whether it's the language which is used, video or audio, like how much pictures were used were kind of helpful in increasing the way they adopted the services.
That's a great question. I think that's an area where other markets are probably more advanced than Kenya. Most of the digital interaction that happens through the phone is either text-based, which would be either in English or Swahili. There's many local tribal languages in Kenya, and most people who have had even basic sort of primary school education would be very comfortable communicating in Swahili, but people who are unschooled, which is a pretty small part of the Kenyan population, would only speak local language, and so they are relying on an agent or a person who can translate from the local language into Swahili or English. I didn't really see any products where where the institutions are using video or audio recordings to communicate. I understand that that's being experimented with in other markets. I didn't see that in Kenya, but if there's anyone here on the webinar who's from Kenya that has seen that, I would be very curious to hear if there is any of that going on. Certainly that was local language was cited as a reason that people wanted to go and talk to a person. One of the respondents said, maybe I want to have this conversation in my mother tongue. I want to go to the branch officer and say, find me somebody who can explain this to me in my mother tongue. So that is definitely a real issue in the Kenyan market. I think maybe more so in some other markets as well.
Great. I hope that answered your question, Abdel. We've got a lot of questions coming in. I'm so excited about this conversation, and we have until 10:30 our time, so the next 22 minutes for our discussion. So that's great. I'd love to turn to Olive Kabatala. I'm so sorry, Kabatalia. I hope I said that right, Olive. Olive, we've unmuted you from our end. Can you try speaking? Olive, can you try speaking? If not, I can ask your question. Okay, well, we'll just leave you unmuted during the discussion, so hopefully you can chime in here and correct me if I butcher you.
Say what percentage of students?
Yep, we can hear you. Go ahead and ask your question, Olive.
Sorry, can you hear me? Yeah, I'm asking about what percentage of the clients of the institutional clientele would you estimate that they are low tech?
Great. So the question is how you define the categories of low touch. So like what % of the clientele are using the digital services or primarily digital services as you classify low touch versus high touch? Talk a little bit more concretely about what that looks like.
Okay, so first of all, hello, Olive. It's good to hear from you. So if I'm understanding the question correctly, I categorize them really based on the kind of interface that is offered by the financial service providers. So for example, with app-based products, it would be 100% low touch because they only offer interface through an app. So in that particular case, the customers have to have a smartphone. And there's no phone number for them to call, so they're forced to connect with the institution through Facebook or through the Google Play Store or through in-app chat. Moving on to, so really it's kind of the institutions that kind of offer various mechanisms. I think maybe the middle ground is what you're asking about. So the hybrid IMFIs and the banks, I actually don't know specifically. I think it would vary by institution, in terms of both what that institution is offering. So for example, Equity is an institution that really has invested in that face-to-face relationship through their branch network and agent banking network. And so I don't have the answer on specifically what % of their traffic. I know they get a lot of loan traffic through digital means, but they're also kind of keep their doors open for the face-to-face conversations as well. So I think it would be institution specific. I'm not sure I've answered your question very well, but maybe hopefully it helps you understand how I've made the categories really based more on how the organization offers the interface.
Great, and let's turn now to Bina. Bina Ravella has a question. Bina, are you? We'd love to open the line to you, so we're unmuting you from our end. We haven't gotten confirmation from you in the chat box whether you're in a place where you're able to talk. So it doesn't look like you're coming up online, but I'll go ahead and just ask your question here. Bina is asking very basically, what are the primary reasons for which institutions and customers opt for digital interventions? Like, why are we even having this conversation?
Right.
And it'd be great if you could talk about the Kenya context specifically, but I know there are applications for the answer to this question very broadly around the world.
Sure. So, I think the speed is a primary wow factor. I talked to one respondent who had heard about Mshwari from her women's group and, started to save, but kind of didn't think about it until she ran out of gas on the side of the road and didn't have any money. So she got an Mshwari loan, which enabled her to buy gas, which enabled her to get home as she was traveling back from her village. So I think it's often urgent expenses that are for the customer sort of a primary way to, or a primary sort of door into a relationship with a digital lender. A different respondent that comes to mind wanted to make a purchase for a client. He was selling stationery, and he had an order for that would cost him $300 US, but he'd be able to sell this order for 600, so like 100% markup. This was a great financial opportunity for him, but he was $50 short of having the money he needed to place the order. So he went to his family members, he went to friends and asked for this $50, but $50, nobody had the $50. So a friend recommended a digital lender. He was hoping for the $50 from the digital lender. He ended up getting 20, but because he then only had to ask for $30, then his sister had 30, not 50, but 30. So a lot of times people, as we know, are kind of piecing together money from different sources. And so a digital provider can be one of those sources in pulling together a sum of money for a larger expense. So that's from the consumer perspective. Certainly from the financial service provider perspective, we've heard a lot of talk about efficiencies, cost efficiencies, just the scale. In a telcos have relationships with millions of customers. So I think both the scale and the cost efficiencies are the main attractive features from the FSP perspective.
And building on that, we have a question from Stephen Wanjala. He asks, how different is the digital design process? I think the question is different than the more high-touch, less digital process. The tendency has been to focus more on the low cost of delivery of products by investing in the technology. Is it the product or the technology to deliver the product that's really the issue here for financial institutions?
Okay, so this is a little bit outside the scope of my research and my expertise, but I do want to say, just having had these conversations with customers, I mean, what's really important to the customer is their experience. I mean, did they get what they were expecting? If they have a question or have a problem, can they fix it? So I do think that really the product development piece is extremely important. You know, technology is sort of the rail line to get you the product, but you know, people are mostly concerned about, you know, the money that they're looking for. I mean, the money is a source to, you know, to get them to a goal. So really, it's the goal that they're looking for. So I think the product development piece and just really this process of customer journey mapping, I think, is a great way to understand how customers really experience these products. So if there's anyone that's interested in you know, using this research approach to understand products or to help them design products, I'd be more than happy to share my research instrument and provide any advice, because I'd love to. I learned so much using this methodology. I'd love to see other institutions use it as well.
That's great. And I would love to jump into the conversation in my prerogative as the moderator. To me, like, the why of this research is really interesting. I mean, thinking about how a financial institution could use the research and the methodology. One of my questions along those lines is, what are the touch points that are ones that are touch points with a human that will fade over time as customers grow increasingly familiar with and comfortable with digital services? And are there any that you can identify that will like really need to endure over time as we move digital?
Yeah, I think that's a great question. And I think the answer depends largely on how good digital gets at meeting those needs. You know, I certainly think everything is going to move, you know, gradually or quickly in some cases, you know, towards digital. But if you think about, you know, sort of that initial experience of building a trusting relationship, you know, I think that a product could, you know, once it has a brand, you know, recognition in the marketplace, I think that could move more digital. I think that's one of the ones that'll probably be 50-50 for, you know, a good long while. Signing up could easily go digital, you know, as people get more comfortable. It's quicker, it's easier. Transactions we're already seeing are going digital. I think, you know, as companies investing in call centers, answering questions can go digital. I think the holdout is going to be resolving problems. And, you know, as was brought up, you know, just that desire to sort of negotiate. Now, a lot of these loans are not as negotiable or not negotiable, you know, certainly as they would be in the informal sector. But I think that desire to have that interaction will always be there. When things go awry, you want to protect that relationship by having a conversation.
Yeah, that's interesting. I'd love to stay on this topic of providers and technologies and sort of what's possible, and open it back up to Lauren Hendricks of Grameen Foundation. Lauren wanted to ask about artificial intelligence, which I think is a good question. I mean, that is kind of a Centaur unicorn. So, Lauren?
Yeah, thanks so much. I just wanted to jump in and see if you saw any examples in Kenya of using artificial intelligence. We've been experimenting with it around digital and financial literacy in India and had some really positive results, and particularly around, you know, knowing whether clients are understanding the messages when they ask questions, how confident they're feeling. And anyway, just wondering if you saw any examples of that, and or how you think that might influence the space in terms of the question Tess was just asking about what's going to go digital versus what's going to stay human.
Yeah, that's a great question. And actually, I'd love to hear more about what you're experiencing in India. I really didn't, I was really focusing on the customer interface side of it. There were no providers that mentioned to me that they were using artificial intelligence, although it was a question I didn't ask. And actually, I know that when I scheduled the appointment with one CEO, I was interacting with an assistant that I thought was a human, but then later discovered was a computer program after we had miscommunicated a little bit. So, so I know that at least there was some AI, going on that front. But I think so. I'd be interested in anyone who's on the line that's from Kenya. If you are using AI, that's not really something that I focused on in the research. And then Lauren, I'd be really interested if you could just give us a quick highlight on what you're doing, what you're finding with the work you're doing. Lauren, do you want to share with us a little bit more about the work you're doing and how it fits in here?
Oh, sure. But I wanted to give the Kenyans a chance to jump in as well. And I will say it's sort of like this. It's still in process, but there's an upcoming at the Microfinance India event in December that we're going to kind of highlight some of the results from the testing of the artificial intelligence. But we've been testing it to try and understand when financial literacy messages are delivered, can you use kind of voice calibration to understand how well clients are understanding the message? And so there's some of that going on, and then there's also on the Q&A side using artificial intelligence to help answer questions as they come in from clients around some of the digital products that they're using with our partners there. So I would say watch the space in terms of our learning around how effective it all is, which is why I'm interested to see if other people are doing it and what other people think the possibilities are for it in the future. I'm happy to pass on the final results when we get them in December.
Yeah, that would be great to see that. That would be great. I'd love to turn to one more person, Tamil Kumar, who has some thoughts on the applicability of this research and has thought about the applicability of some of these lessons in the India context, incidentally. So Tamil, we have unmuted you from our end and would love for you to test your microphone, see if we can get you on the line here, given the technology constraints on your end. Tamil, are you with us? Okay, it doesn't sound like we have you, but Tamil's comment was, in India, this might be an opportunity to lessen the gap through digital. So in India, she sees this not as incorporating human touch into digital products, but rather as where can we incorporate digital into an existing primarily high touch based system. So I think that's really interesting, and I would love for your comments, Alexis, on that. It's sort of a reverse process, a different way of thinking about this.
Right. Yeah, I think when you look at the centaur, I think some of us are walking around with the horse legs, and some of us are maybe sitting on a stump with just the human top half of our body. So it's kind of which direction are you coming from? And I think that and the answer is really where are you coming from? So a lot of the spectrum of institutions that participated in this research really did cover all the way from low touch, where they're looking more at, are we connecting with our clients? We really want to be, I heard expressed, we really want to be a valued partner. Are we achieving that through low touch interface? And so they're looking at questions of like, are we serving our customers? Are we responding quickly enough? Are we solving their problems? On the other end of the spectrum, the institutions that are coming from the high touch traditional microfinance background are looking at how do we incorporate technology? Do we either, whether it be through digitizing our client data, which is a very valuable resource that segment has, or is it through partnering with a telco? So there's a lot of different steps that could be taken either direction. And I did want to just comment, I really do agree with the point also of achieving sort of Centaur product status through partnerships, acknowledging that not every institution can be everything. So that's a very strategic way to go about that.
Yeah, that's interesting. Alexis, before we close, are there any other comments or summary reflections that you want to make on the research?
I think we've covered, a lot of great questions. I think, and so I guess maybe the one reflection that I will come from, share at the end was, so I come from a traditional microfinance background. So I think when I came into this research, part of what I was wondering is, like, how does this work? Among this target client that I, market that I've worked with for 20 years, this new breed of program, of products, how is it serving them? And I think I found that it is really serving them well in some cases. It's providing a valuable need. I mean, we're not seeing these massive uptake and usage numbers for nothing. And so I think coming out of it, it really is that other question of how do we incorporate digital into the human? And because I think that, we don't want to be in a position where, you kind of, we've heard sort of the sky is falling, that, what John referenced, that digital is going to, take over the future of this space. And I do think there will always be a need for human touch, but I do think also human touch based organizations need to leverage digital opportunities to make their field staff more efficient. They do have, as was pointed out, incredible advantage to know, is this person a maize farmer or a tomato farmer? Because those are completely different, businesses, cash flow cycles, different risk profiles. So really having that information and then the flexibility that information with digital, with sort of the increased controls and client awareness tracking and, just segmenting your clients and understanding the patterns in your segments really opens up a huge world of opportunity. So I think it's really exciting moving forward, and I'm excited to continue watching this space.
Great. Thanks so much, Alexis. Thank you, John and Lauren, for joining us and serving as respondents. Thank you to the Rockefeller Foundation for your generous financial support of this program. Thanks to our team here in DC, Neil Kennedy and Tess Johnson, who are fielding questions and managing the technology. Thanks to all of you who joined us today for taking the time to engage with this work. And we really look forward to you joining us next time. Again, I want to remind you that we're going to keep the handout in the handouts section of the webinar, so you can download the report directly, or you can visit our website and read the report there and download a summary at bit.ly, that's bit.ly/Human Touch DFS Kenya. Or you can read more about the Fellows Program at bit.ly/CFI-Fellows. Thanks so much. A poll will be popping up on your screen in a few seconds just to rate your opinion of this webinar, and we look forward to seeing you next time. Thanks.